Good day, everyone. So we are the group 3 and we will be discussing about the Philippine Accounting Standard 16, 17, 18, 19, and 20. So we go now to the presentation. So the outline of the topic of Accounting Standard
Ba't wag kang maingay,
16 will be the
magre-report
definition,
ako.
recognition, initial measurement, and subsequent measurement of cost, construction, the recognition, fully depreciated property depreciation. So we go now to the definition of the Philippine Accounting Standard 16, which is the property, plant, and equipment. So property, plant, and equipment are tangible assets that are held for use in production or supply of goods or services, for rental to others, or for administrative purposes, and are expected to be used during more than one period. So, dito sa property, plant, and equipment, ito yung mga long-term asset that is vital to business operation and long-term financial health of a company, equipment, machinery, buildings, and vehicles. So, the characteristic of property, plant, and equipment, we have the tangible asset, which is items of property, plant, and equipment have physical substance. Example nito is yung mga land, properties, machinery, and furniture in which we can see or nahawakan natin. Then, we have the use in normal operations. Items of property, plant, and equipment are used in the production or supply of goods or services for rental or administrative purposes. And we have the long-term in nature, the items of property, plant, and equipment that is expected to be used from more than 1 year. So, nandito yung example ng property, plant, and equipment. We go now to the recognition. So, the recognition of the property, plant, and equipment is it is probable that future economic benefits associated with the items will flow to the entity, and B, the cost of the item can be measured reliably, and initial measurement an item of property, plant, and equipment is initially measured its cost, wherein property, plant, and equipment ay nami-measure sa cost in which the cost of a item or property, plant, and equipment, ito yung cash price or equivalent ng recognition. So, next is the elements of cost. Number one is the purchase price. Two is cost directly attributable to bringing the asset to the location and condition necessary. And number three, present value of decommissioning and restoration. Wherein dito sa element of cost, wherein capitalized cost ng property, plant, and equipment includes ng lahat ng mga expenditure na kailangan na i-acquire sa asset. Bring it to its location and state where it is ready for use, and discharge obligation associated with asset, even disposal like site restoration. So, nandito yung mga cost na not qualifying for recognition. Nandiyan yung mga cost of opening a new facility, cost of introducing a new product or service, including cost of advertising and promotion and such. Next is the subsequent measurement after the recognition, wherein dito, sa subsequent to initial recognition, an entity shall choose either the cost model or the revaluation model, in which dito sa subsequent model, ito yung model after recognition ng isang property, plant, and equipment ay nami-measure sa cost less any accumulated depreciation and accumulated impairment losses. Tapos sa revaluation model naman, ito yung after recognition ng asset of an item ng property, plant of equipment whose fair value can be measured reliably shall be carried at revalued amount being fair value at the date of the revaluation, less any subsequent accumulated depreciation and subsequent accumulated impairment losses. Dito naman tayo sa measurement of cost. Meron tayong acquisition on a cash basis, installment basis on account, saka on installment basis. Wherein dito sa cash basis, where the cost of asset included cash paid directly attributable costs, such as freight installation direct freight installation directly attributable costs, such as yung mga cost na necessary in bringing the asset to the location and condition for the intended use. Tapos sa on account naman, dito yung mga cash discount are generally considered as reduction of cost and not as in one. Wherein sa installment basis naman, the difference between the cash price equivalent and the installment price is recognized sa interest to be amortized over the period of credit unless such interest is capitalized in accordance with the Philippine Accounting Standard 23, which is the borrowing cost. So dito yung mga measurement of cost, issuance of share capital and bonds payable. Dito sa issuance of share capital, accordingly where property, plant and equipment is acquired through the issuance of share capital shall be measured at an amount equal to the following in the order of priority. Number 1 is the fair value of the property received. Number 2, fair value of the share capital. Number 3, par value of stated value of the share capital. So, dito naman sa issuance ng bonds payable under the PFRS 9, paragraph 5.1.1, which provides the asset acquired by issuing bonds payable is measured in the following order. Number 1, fair value of bonds payable. Number 2, fair value of asset received. And number 3 is the face amount of bonds paid. So, meron pa dito yung acquisition through exchange and merong sa past 16 paragraph 24 na nag-cost ng item ng PPE acquired in exchange for non-monetary asset or a combination of monetary and non-monetary asset is measured at fair value plus any cash payment. Tapos dito sa acquisition through exchange, if the exchange has commercial substance, the asset received from the exchange is measured using the following order of priority. Dito is parang yung naka-bold yung GRG, which is the given up, receive, and carrying amount of asset given up. Next is the construction. The cost of self-constructed property, plant, and equipment includes direct cost of materials, direct cost of labor, indirect costs, and incremental overhead, specifically identifiable or traceable to the construction. Wherein dito sa construction, in the past 16 paragraph 22, nagpro-provide ng cost ng mga abnormal amount or tinatawag na wasted material, labor, or overhead na nai-incurred in the production of self-constructed asset, which is hindi na included sa cost ng asset. Then, next is the derecognition. It means that the cost of property, plant, and equipment together with the related accumulated depreciation shall be removed from the amounts from the accounts. The carrying amount of an item or property, plant, and equipment shall be recognized. Una is yung sa disposal or when no future economic benefits are expected from its use or disposal. Wherein the gains or loss from the recognition shall be included in the profit or loss and treated as another income. Next, fully depreciated property. A property is said to be fully depreciated when the carrying amount is equal to the residual value. In such a case, the asset account and the related accumulated depreciation account are closed and the residual value is set up in a separate account. Wherein, however, entities encouraged but not required to disclose fully depreciated property. Dito na sa depreciation is the systematic allocation of the depreciable amount of an asset over its estimated useful life. So, pag nagko-compute ng depreciation, each part ng item ng property, plant, and equipment with the cost that is significant in relation to the total cost of the item shall be depreciated separately. So, ito yung mga factor ng depreciation, yung depreciable amount, residual value, useful life. And yung pag-determine na factors ng determining in useful life is expected usage of the asset, expected physical wear and tear, technical or commercial obsolescence, legal limits for the use of the asset, such as the expiry date or day-related lease. So, yung methods ng depreciation, meron tayong straight line method wherein depreciation is recognized evenly over the life of the asset by dividing the depreciable amount by the estimated useful life. So, nandito yung formula to get the straight line method sa depreciation where depreciation is equal to historical cost minus the residual value divided by the estimated useful life. So, meron ding production method which assumes that depreciation is more a function of use rather than the pass of time. The useful life of the asset is considered in terms of the output produces or the number of hours it works. So, last is the diminishing balance or accelerated method. This method provides the higher depreciation in the earlier years and lower depreciation in the later years of the useful life of the asset. So, meron din mga revaluation applied to all asset and subsequent accounting for revaluation asset. Then, we go now to the Philippine Accounting Standard 17, which is the LESIS, and the outline of the topic that will be discussed is the background, objective, and scope, definition, types of arrangement, disclosure, and sale and lease back transactions too. So, background ng PAS 17, which it was originally issued in September 1982, a project to reduce or eliminate alternatives, redundancies, and conflicts with the standards to deal with some convergence issues and to make other improvements was undertaken. Wherein dito sa Philippine Accounting Standard 17, nagpre-prescribe ng accounting policies and disclosures applicant to lessees, both from lessees and lessors. So, ito yung objective ng PAS 17, which is to prescribe for lessees and lessors the appropriate accounting policies and disclosure to apply in relation to lessees. Yung scope naman is applies to all lessees other than A. Lessees to explore for use minerals, oil, natural gas, and similar non-regenerative resources, and B. Licensing agreements for such items as motion pictures, films, video recordings, plays, manuscripts, patents, and copyrights. So, definition, wherein lessee is an agreement whereby the lessor conveys to the lessee in return for a payment or series of payments the right to use an asset for an agreed period of time. So, lessee is an contract by which conveys real estate, equipment, or facilities for a specified term and for a specified rent. So, meron ding types of arrangement ang lessee, wherein meron yung una is yung finance, where the contract that permits the use of an asset and nagtatransfer ng ownership after the lessee period is complete and the lessor meets all other contract obligations. Then we have the types of arrangements, which the lessee finance lease criteria must meet just one condition to capitalize ownership transfers at end of lessee upon final payment or required buyout written option for bargain purchase. Then 90% of lease property fair value measurement present value of lease payments. 75% naman sa asset economic life is being committed in lease term. So, meron pang mga rewards of ownership and types of arrangement indicator where the lessee transfer ownership of the asset to the lessee by the end of the lease term. The lessee has the option to purchase the asset at a bargain price. So, pag yung sa bargain price, it is a low price that is good for the buyer. Sold out at the low price. So, meron ding type and arrangement, which is a transference of risk and reward is assumed if the lessee has the use of the asset for most of its economic life. The lessee bears the cost normally associated with ownership. The present value of the amounts guaranteed by the lessee is materially equivalent to the cost purchase, and any amounts accruing to the lessor at the end of the lease are relatively small. And the type of arrangement, land and building. So, land normally has an indefinite economic life. If title does not pass at the end of the lease term, and the lease should normally be classified as operating lease. Buildings' useful life will probably extend well beyond the lease term. If title does not pass at the end of the lease term, the less will be classed as operating lease. If it pass, both are classified as finance lessees. So, disclosure. Lessor and lessee shall be disclosed the following sa operating lessees, which the future minimum lease payments under non-cancelable operating lessees in the aggregate, and total contingent rents recognized as income in the period, and a general description of the lessor's leasing arrangements. Thus, my lessees disclosure finance lessees. Lessor shall disclose the following for finance. Yung kanina operating, dito naman sa finance lease, a reconciliation between the gross investment in the lease at the BS date and the PV of minimum lease and payment receivable at the BS, unearned finance income, and the accumulated allowance for uncollectible minimum lease payment receivable, and a general description of the leasing arrangements. So, disclosure. So, may sale and leaseback as a finance lease wherein any excess ng sales proceed over the carrying amount should be deferred and amortized over the lease term.
Next, Pass 18, Revenue Recognition. Outline of topics. Number 1, definitions of revenue and fair value. 2, measurement of revenue. 3, sales of goods. 4, rendering of services. 5, interest, royalties, and dividends. Definitions. First, what is revenue? Revenue, the gross inflow of economic benefits during the period arising in the course of ordinary activities of an entity. Ordinary activities means basically sales of goods, rendering services, receiving interest, royalties, and dividends. Revenue causes increase in equity, but other from equity participants. So, if the shareholders decides to provide more cash to their company by increasing share capital, it is known as revenue. Examples of revenue include sales, service revenues, fees earned, interest revenue, and interest income. Next, what is fair value? The amount for which an asset could be exchanged or a liability settled between knowledgeable, willing parties in arm's length transaction. Next, sales of goods. Revenue arising from the sale of goods should be recognized when all the following criteria have been satisfied. First, significant risks and rewards transferred to the buyer. The seller has transferred to the buyer the significant risks and rewards of ownership. Second, no effective control over the goods sold is retained. The seller retains neither continuing managerial involvement to the degree usually associated with ownership nor effective control over the goods sold. Next, revenue reliably measurable. The amount of the revenue can be measured reliably. 4. Economic benefits from transaction flow to the entity. It is probable that the economic benefits associated with the transaction will flow to the seller. And last, costs in respect of the transaction reliably measurable. The costs incurred or to be incurred in respect of transaction can be measured reliably. Now, let's go to rendering of services. This is the case when all the following conditions are satisfied. First, the amount of revenue can be measured reliably. Second, it is probable that the economic benefits associated with the transaction will flow to the entity. Third, the stage of completion of the transaction at the end of the reporting period can be measured reliably. And last, the cost incurred for the transaction and the cost to complete the transaction can be measured. For revenue arising from the rendering of services, provided that all of the following criteria are met, revenue should be recognized by reference to the stage of completion of the transaction at the balance sheet. When above criteria are not met, revenue arising from the rendering of services should be recognized only to the extent of expenses recognized that are recoverable. Last topic are the interest, royalties, and dividends. Interest should be recognized using the effective interest method or the PAS 39. Interest is the charge against the money that is offered to the borrower. Second, royalties. Royalties should be recognized on an accrual basis in accordance with the substance of the relevant agreement. Royalties are the compensation paid to the owner for the use of property, usually copyrighted material or natural resources such as mines, oil wells, or timber tract. Last is the dividends. Dividends should be recognized when the shareholder's right to receive payment is established. A dividend is a percentage of profit offered to a company's shareholders. Dividends and interest are returns on capital investments such as stocks, bonds, or savings account.
PAS 19. Employee benefits. Employee benefits include all forms of consideration given by an enterprise in exchange for service rendered by employees. Such benefits are either in the form of compensation in financial assets, goods and services, and equity instrument of the employer. Employees are increasingly becoming concerned not only their periodic remuneration, which is yung salary nila buwan-buwan, but but also the retirement planning, wherein it is for the reason that many employers have established pension plans and other employee benefit plans to encourage their employees to stay with the company. Next. PAS 19 identifies four categories of employee benefits as follows. Number one is short-term employee benefits. Are those except termination benefits expected to be settled wholly before 12 months before the end of the annual reporting period in which the employees render the related services. Um, they include the wages, salaries, social security contributions, paid annual leave, and etc. Recognitions and measurement. The short-term employee benefits are recognized as an expense during an accounting period when the employee has rendered service, unless the cost of such employee benefits forms part of the cost of another asset, such as inventories or property, plant and equipment. At the end of the accounting period, the unpaid amount of these short-term benefits shall be recognized as a liability at its undiscounted amount. The actual wages and salaries at the year end is recorded by charging compensation expense or equivalent account and crediting accrued liability. Next slide. Short-term employee benefits, meron tayong accumulating and non-accumulating. The accumulating short-term employee benefits are accumulating compensated absences are those that are carried forward and can be used in future periods if the current period's entitlement is not used in full. Accumulating compensated absences are either vesting or non-vesting. A benefit is vesting if the employee is entitled to receive the benefits at the date he leaves the company. And the non-accumulating short-term employee benefits naman, ito yung compensated absences do not carry forward and do not require accrual at the year end. Thus, an entity shall recognize the cost of non-accumulating compensated absences when the absences occurred. Such costs are recorded as an expense unless another standard requires the same to be recognized as a part of the cost of another assets. Example nito ay inventories or operating assets. And next, number 2 is the post-employment benefits. Are those other than termination benefits and short-term employee benefits that are payable after the completion of employment. It is include the pension and lump sum payments on retirement, post-employment life insurance, and post-employment medical care. And post-employment benefits plans are generally take the form of retirement benefit plans or pension plans. It is classified in the following ways. Number 1 is contributory plans. Contributory plans, a plan is contributory if both the employer and the employee are required to make contributions to the fund assets. And non-contributory plans, if under the plan the employee is not required to make contribution of his retirement benefits. And second is fund plans. Fund plans and unfunded plans. Funded Funded plans. A plan is funded if a trustee is designated to administer the resources accumulated in the fund. And unfunded plans naman ay if yung employers ay retain the obligation to pay the employees their post-employment benefits. And the third one is defined contribution plans and defined benefit plans. The defined benefit plans are the employer's legal and constructive obligation is limited to the amount that it agrees to contribute to the fund. While the defined benefit plans naman ay the employer has to estimate um, the amount of periodic contribution to the plan that will accumulate enough funds for future retirement of its employees. Next, other long-term benefits, employee benefits. The third one are employee benefits other than short-term employee benefits, post-employment benefits, and termination benefits. They include the long service leave and sabbatical leave, jubilee, or other long service benefits, long-term stability benefits. These employee benefits includes the long-term paid absences such as long service or sabbatical leave. Second, jubilee or other long service benefits. Third, long-term disability benefits. Fourth, profit sharing and bonuses payable 12 months or more after the end of the period in which the employee rendered the related services. And the last one is deferred remuneration. An accounting for other long-term employee benefits follows the same accounting principle for retirement benefits under the defined benefit plans, except that no part of remeasurement shall be taken to other comprehensive income. And next, the last one, category is next is the termination benefits. Termination benefits are employees' benefit provided in exchange for the termination of an employee's employment as a result of either an entity's decision to terminate an employee's employment before the normal retirement date or an employee's decision to accept an offer of benefits in exchange for the termination of employment. The termination benefits are employee benefits payable as a result of either A. An entity's decision to terminate employment, or B. An employee's decision to accept an entity's offer of benefits in exchange for termination of employment. An entity shall recognize a liability and expenses for termination of benefits at the earlier of the following dates: A. When the entity can no longer withdraw the offer of those benefits, and when the entity recognizes costs for restructuring and involves the payment of termination benefits. If the termination benefits are an enhancement to post-employment benefits, the entity shall apply the principles for post-employment benefits. Otherwise, an entity shall measure the termination benefits in accordance with the nature of the benefits. And next, and these are the disclosure requirements of employees' benefits. Number one is an entity shall disclose the amount recognized as an expense for short-term employee benefits. Second, an entity shall disclose the amount recognized an expense contribution plans. And the third one, an entity shall disclose the following information about defined benefit plans. Next, reporter.
Good day to all. This will be our discussions involving government grants. Our related standard for this is PAS 20. Next. PAS 20 or Philippine Accounting Standard number 20, and that is accounting for government grants and disclosure of government assistance. That is the complete title. This will be any grant could be cash or non-cash assets provided by the government. So how do we account for that? And disclosures only for government assistance, which are normally services provided by the government. For learning objectives or outcomes of this chapter, we should be able to explain the recognition and measurement of government grants. When do we recognize? When do we journalize? What are the requirements for such recognition, recording, or journalizing of government grants? And of course, for journalizing that is closely related to measurement. After that, explain the presentation of government grants in the financial statements. How do we present or place government grants on our financial statements? Normally, the statement of comprehensive income in the statement of financial position. Next. For definitions, government grants are assistances or assistance by government in the form of transfers or resources as said could be cash or non-cash assets to an entity in return for past or future compliance with certain conditions relating to the operating activities of the entity. Normally, when the government provides or transfers resources to a certain business, there would be some conditions attached. The conditions attached could be varying on situations, meaning it's going to be a case-to-case basis. They exclude those forms of government assistance which cannot reasonably have a value. So take note that government grants have amounts that can be stated or measured for services or assistance. If they do not have reasonably of value, then we do not account them as government grants. I said a while ago, they will be disclosed in the notes to financial statements. So to continue transaction with government, which cannot be distinguished from the normal trading transactions of the entity because some services cannot be physically and properly segregated from the others if not physical, so proper segregation cannot be done, or we cannot be specific to the entity because for government grants, it should be a financial item that is specific to a certain entity. Other terms for government grants include subsidies, or premiums, and we can of course have the word government prior in order to differentiate it from the other items or grants, subsidies, subventions, or premiums. Next po. Then as said, there are items that are basically not government grants on top of the government assistance, which is also a separate classifications, but there are also even services that are clearly not government grants and government assistance, like tax benefits provided by the government that's already under taxation, so it's not something unique or specific to a certain entity or provided to an entity free, technical, or marketing advice. It's for free, no value. Their provisions of guarantees wherein the government would be shouldering certain debt. So in that case, we are not yet certain if this really of a financial value or not government procurement policy that is responsible for a portion of the entity sale. If it's not procurement, this is the purchase. So government is partnering with a certain organization, and then for example, the government is being a partner with the entity, so there is some sort of policy, and then that would result to portion if not significant portion of the entity sales. The business is that case that parts of the purchasing contract for the bidding process in the purchasing contract later, therefore that's not government grant. And finally, public improvements that benefit the entire community, wherein it's very clear here it's for the public, it's not specific to the entity again for a government grant. To be one, it should be that the benefit in the form of cash or non-cash assets should be specific to a certain business or entity. Next. Now for recognition, that is for our journalizing and reporting government grants, including non-monetary grants at fair value, so not necessary in money, could be in other non-cash assets like land, building, and etc., shall not be recognized until there is a reasonable assurance that the entity will comply with the conditions attaching to them and that the grants will be received. So these are the two requirements that should be taken into before an entity should recognize any government grant. Next. Then classification of the government grants according to attached condition. So the grants could be related to assets, wherein primary conditions is that an entity qualifying for them should purchase, contract, or otherwise acquire long-term assets. Hence the terms related to assets. So whatever amount is to be given, the condition is that the entity should acquire certain assets and then grants related to income other than those related to assets. So it could be other conditions attached like money is given in order to finance or support certain calamities. Next. So initial measurement for monetary grants, they are to be measured at the following. So amount of cash received, the amount or if it's the receivable, the fair value of the amount under past 39. And then you also have, of course, our PFRS 9 for financial instrument of carrying amount of loan payable to government for which repayment is forgiven in the case of supposedly there is an amount to be paid by the government, it is forgiven, therefore that sort of income on the part of their or the far work than the discount on loan payable to government at a below market rate of interest. Ito also an interesting government grant. So let's say the face value is 2 million and you are given the discount. So let's say in the form of instead of 2 million face value, we will be receiving like 2.5 million, so that 500,000 is a sort of government grants on our case. Next, non-monetary grants, for example, land and other resources, are measured at the fair value. This is the course of a basic concept for non-cash assets, wherein they have to be reported at fair values. And as an alternative or another option, it can be a nominal amount or any other amount if no fair value or zero, plus direct costs incurred in preparing the assets for its intended use, which is something that is secondary because under PFRS 13 fair value measurement, there is rebutable presumptions, although not absolute, that we can determine the fair value of non-monetary assets. So in that case, that's the reason that there is really fair value to consider, but just in the case there's an alternative. Next po. Then for accounting for government grants, we have to take note of the matching concept. This is the main concept in accounting for government grants. We recognize income in the government brand as the entity recognizes. Expenses, they are related or that is related to the cost for which the grant is intended to compensate. To say there is an expense that is there like losses from calamities, and the government will provide income in order to match, in order to compensate. Of course, for that particular expense, at least it can help alleviate that particular loss, if not, let's say, 100% offset or cover, so at least it can compensate a portion of that loss, for example, or even any other expenses. Next po. Then we present government grants related to assets on the statements of financial positions. There are actually two options, either gross or net. For the gross presentation, it has to be presented as a deferred income or liability, in which initially that's a liability, but it will be earned along the way. So for example, if that is a grant related to a non-depreciable asset, so of course it will also be based, let's say, on the number of years that the grant will be usable or will be provided to a certain entity. And that can be used in certain number of years for the operations for the depreciable assets, which is the most common, or I would say more common, if we compare depreciable versus non-depreciable work in whatever is that depreciation method for the depreciable asset and the number of years, because that is very important, especially for depreciations methods of factors of times of passage of time. So we just simply use a straight line method in order to get the income or the income portion of the deferred income. So there is a transfer from liability to income, and how much is that will be the amount of the grant divided by the number of years or net presentations. The grant is deducted when computing for the carrying amount of the asset. So whatever in the carrying amount, you are going to net that with the graph or vice versa. Then what about if related to income? In this case, we have two options. So it's either gross presentation or net presentation. For gross presentation, we are going to present as part of their income on our statement of comprehensive income, formerly known as income statement after gross profit or gross income. For example, in other incomes, so we will put there as a part of other income and then other income. The details will be disclosed in the notes of financial statements with our income. For example, coming from the government grant, that is automatic, or as a whole, especially if it related to expense that is to be recorded immediately. Like the casualty law says, so income immediately because the loss or the expense is there. But then for the example, if it's related to a depreciable assets, remember that depreciation expenses will be all throughout the years of the life of that. So in that case, we have to recognize the grant in relation to that time period. So in other words, what will be shown on a statement of comprehensive income under other income section will only be the transfer. So from the deferred income to income, because this is the income statement, or again now known as a statement of comprehensive income. Another one is net presentation, wherein the grants is deducted in reporting the related expense. So expense net with the income coming from the grant, normally for the two while ago in relations to assets related to assets for presentation or assets, and now to income we use gross presentation in order to show the details, but it doesn't mean that the net presentation is wrong. Next. And finally, what about repayment of government grants? Now it's possible that a government grant that becomes repayable. So example, we did not follow the conditions attached to our government grants. So we violate that, in other words, or we breach the terms of the contract. Therefore, the grant becomes repayable. We have to refund that or return to the corresponding government agency or the government as a whole. In that case, you have to account for the change as a change in accounting estimates, wherein we have to account for its prospectively, meaning to say in current and future periods. So what happened in the past remains or stays in the past. We just have to incorporate the change in the present and make the necessary adjustment. So this would result normally to a loss, because supposedly we have an income and then we violated the contract, so there is a loss for the repayment of the grant that is under past 8. Our accounting standard for accounting policies, changes in accounting estimates and errors. So this is the end of our discussions of juries. Hopefully you got something from the session. Thank you.